and welcome to the Trading Zone. I'm Joe T. Gay of Equity Armor Investments, former VIX and SPX options market maker on the SIBO, current portfolio manager of the Rational Equity Armor Fund and the Catalyst Hedge Equity Fund. I hope you have had a great weekend. I hope you're having a great start to the week. Market's not off to a fantastic start. It's not hitting on all cylinders, I should say, but there are some bright spots to the market, some negative spots. NVDA, of course, having a nice bounce back after its rough week, where the market had kind of doing the opposite of what happened last week. Bit of a shiftaroo going around here. Interesting to see, fun to see. I always just love trading, just love seeing the ripples that are going around in the world. And speaking of ripples, make sure check out the Ripple Effect blog if you're here today. No reason why you should not be clicking on this button on the bottom and subscribing. But yeah, today's article is going to be a lot about what the show today is about, is the volatility of NVIDIA and NVIDIA and how they are just so tied into the market. You know, NVIDIA used to be very recently less than 1% on the S&P 500. Now we're up over 6%. So the volatility that NVIDIA experiences is going to be in the market. Just something we can't escape. It's going to be something that we're going to just have to ride through. And it's just part of the game. If we want to be in this AI trade, we have to accept volatility is going to be here and with us. So make sure you stick around for the whole show, because I'm going to be talking about all this. I'm talking about NVIDIA, Bitcoin, the end carry trade, and how to ride the volatility. I even have an options trade with NVIDIA at the very end if you do stick around. So yeah, it's just me today. Brian is out with a little bit of a head cold. Maybe he's just in disbelief that the Bears are as looking as good as they do, beating the Eagles first place in the NFC. I'm personally, I also don't believe it, but it is the reality of it. Speaking of the reality, man, what a turnaround in volatility last week into Thanksgiving. The VIX just absolutely smashed and hammered. We had the VIX up over 25 2 weeks ago, and now here we are last Friday. I think it was a 16 handle, bouncing back again today after the holiday, and with a little bit of a downward pressure in some of the stocks. A little bit of a bounce back, but yeah, volatility got super high and then it got super cheap. Need to remember with volatility, it's not going to be going higher up and to the right over time like we hope stocks will and other assets do. We should expect to see this heart rate monitor up and down. When it's too low, you should expect it to want to go higher. When it's too high, you should expect it to want to go lower. And maybe this was the sign that, you know, we weren't going to be bouncing away and going crazy. Was the bond market volatility absolutely hung in there. It did not go crazy, and now we're just smashing back down here towards this relative lows here. So this is just absolutely astonishing to me. We know about the yen carry trade. We know the risk that's happening. We do have the talk of a hawkish Bank of Japan. The yen, they look like they're raising rates at the same time we're lowering rates. Is that going to cause some problems with the carry trade? Well, here's a sign that it really isn't. Another sign that this really isn't spilling over from any of the corporate debt that we're worried about too. So the bond market volatility, absolutely non-existent, really a sign of health for the market. But there are other issues out there. We'll get into that with Bitcoin in just a second. Of course, whoops, wrong way. Go back. Okay, of course, we got the skew index here. The skew index, another under the surface volatility indicator, and we love to look at this. Kind of a key indicator for us. Really gives us a clue as to where the VIX is going next. We continue to have this like trend of like higher lows here. I think this makes sense to me as we're getting further into this AI bubble. We should just expect to see, you know, maybe not the bubble popping, but the volatility floor just continually getting higher and higher and higher, because as we know, the bigger they are, the harder they fall, the higher the PE's ratio go, the more volatility we should expect, all of the above. So while this doesn't mean that the bubble's imminently popping, it just means that this is just what we have to accept. If we want to have a bubble like we saw in the 90s, we have to accept that there's going to be some volatility on the way. Maybe we don't even need to have a bubble. Maybe we can just have a slower, sustainable growth. Like we're seeing this year in the S&P 500, a 15% year. If that's where we end up, that's not bad at all by any stretch of the imaginations. But it's not like the bubble territory where you'd see 40% year after year. For the record, the projections for growth over the next 5 years is 18%. The S&P 500. So the earnings growth is projected at 18% for the next 5 years. That is, that's pretty high. I think that would be a really great return if we were to see that over the next 5 years. But that's just where the projections are. If we don't quite meet that, maybe a little bit of a sell-off would be in order. Again, doesn't necessarily mean we need to correct 40% or worse like we've seen in previous corrections. Right now in the volatility futures curve, looking at the VIX futures, we have, as you can see, a big drop in where the spot was. The front month cash was kind of predicting that. It was well lower. So it was kind of saying, hey, we're going to be coming down here. Now we're back into the normalization here. We got a normal futures curve where we have the spot below the front below the second, et cetera, where you expect to see this slope like that, and we have that, and maybe that's a good sign for bulls. But again, we need to kind of just get past this Bitcoin turbulence volatility, and we'll see. Maybe it'll be after the Fed. Maybe it'll take into next year as we just kind of chop around here and consolidate with this market. Not the worst thing in the world again. Okay, so here's some big events this week at ISM Manufacturing. Already passed that. ADP is on Wednesday. This will be the last jobs data before the Fed meeting. We do have the PCE on Friday. That is the Fed's preferred inflation gauge. The actual Fed meeting will be on the 10th. The jobs number is going to come after the Fed meeting, so that's kind of an interesting dynamic. Right now, the market's pricing in the Fed will cut. How hawkish, how dovish they will be on that cut, we'll see. Given the fact they've had a few cuts in a row, it wouldn't surprise me if they, do one thing and say another. So cut and then be hawkish after that. We'll see. That's kind of what they do. But then we'll get the jobs number, of course, after. And we also are going to have the Japanese central bank December 19th. So a lot coming up. It's going to be a busy month of December. It's really an important month. If we're going to have a positive 2026, I think it's kind of important that we have a positive December and a positive start in January. It's really crucial. If you go back in time looking at calendar years, you can see in December is kind of an important test for the next year to see if you're up or down. So we'll be watching it closely as usual. Last week on the show, if we remember, we were flirting with this 50-day moving average. We were below this 50-day moving average. This was kind of a critical spot. We are definitively above it. That's great. That's why the volatility got hammered so hard, plus the holiday, et cetera. But it does not say we're out of the woods, of course. Obviously, we'd love to see a new relative high. Lots of different possibilities here. Just looking at this on the charts, you could see this turning into a head and shoulders topping formation. That's one possibility. Or maybe you could see this the other way if we go around and get supported here at the 50-day moving average and see this a head and shoulders bottoming formation. So just kind of watching it all develop. The 50-day moving average is very important for me. As long as we're above that, that is very good. Very risky the closer you get to that. So just because we poked our heads above it for a little bit does not mean we're out of the woods. It could be a little bit of a shakeout. But the same story is happening in essentially all of these indexes we're going to look at. Same things happening on the NASDAQ, not nearly as close to its recent relative high. So maybe some broader strength outside of the tech index. And very similar in the semiconductor index. But again, good that we're above the 50-day moving average here, maybe above that spot, but still very much a danger at this head and shoulders topping formation. Not the best if that were to materialize. We should be very careful of that. Mag 7 really stalled out. This was above the 50-day moving average last Monday. really kind of signaling, hey, the market's going to be just fine. Google was leading the way. Google was taking the reins away from NVDA. NVIDIA here, getting this index racing higher. And then we saw some pain in NVIDIA, some gains in Google, some pullback in Google. So it's kind of chopping around here. Should be very, this will lead the market, in my opinion. If we get a break below this 50-day moving average here, the rest of the market will follow. So it's very, very important chart to watch. Back to always, I love to look at the 1990s versus today. If you go back to when the Fed first cut in the 90s compared to when the Fed first cut in the 2020s, we would be right here. So if we do experience a bubble and then a crash, I think there are worse things to experience than this part of the ride. That would be fantastic. Just remember, though, we're going to see some massive pips and points. So that, we just have to accept the fact that volatility will be with us if we are going to be on this ride. And it certainly seems like that is the case. So we talked about the risk-off sentiment. One explanation, of course, is the MicroStrategy forced liquidation potential of Bitcoin. They are very likely going to be taken off of a lot of the exchanges. So they're probably going to be, removed from the NASDAQ 100. It's going to be some forced selling of MicroStrategy. Does that mean that they're going to be forced to sell some Bitcoin? They're saying yes. Maybe they're saying maybe they'd have to, they would if they need, type of a thing. It's not great. This is really just bad for Bitcoin in general. And of course, Bitcoin has been sliding lower. And really, if you kind of think of the risk on, risk off narrative, Bitcoin and NVIDIA are really the two things that I think of when I think of risk on and risk off. And it's just a very highly correlated trade, NVIDIA and Bitcoin. If you go back over the past 5 years, you'll see NVIDIA and Bitcoin just absolutely trading in tandem. And in fact, I have that on our blog here today. If you just look at here, you can see this is Bitcoin in red, NVIDIA here. As sometimes NVIDIA comes first, sometimes Bitcoin comes first, but it's a risk-off sentiment. There are two of the more risky assets people have been investing in over the past 5 years. You can see they very highly correlate each other. It used to be the case that NVIDIA was a proxy for mining some cryptocurrency, etc. And now it's more of just like a risk on, tech off type of a trade. But there's also the component of the carry trade. And that's another big component to Bitcoin. As I mentioned, that the yen is going higher compared to the dollar. When you see the dollar, the Fed's expected to cut. In Japan, they're expected to raise. The carry trade happened to be that the yen was always at zero borrowing costs, so you could borrow money very cheaply in Japan. You could get risk-free return going over the seas to America. So you kind of do that on leverage, and that kind of built up some stress in the financial system when this thing unwinds. And then some people would take a little extra leverage and say, hey, I got risk-free cash going on in America. Can I buy some stocks with that? And of course, if they're buying stocks, they're very likely buying stocks like NVIDIA. So this is all very correlated. As when you see this kind of the negative USD JPY chart, when you see the yen strengthening, boy, that can be really bad for stocks. So just something to keep in mind. We'll get through it. It doesn't necessarily mean it's going to be a fun ride, but it also doesn't mean that stocks are necessarily have to go to zero. And of course, this has been happening again and again for some time. They had the big blowout last August in the Yen-mageddon trade. I think traders are much better prepared for that right now, much more expecting or tolerant of that type of an outcome right now. So as we mentioned, Google, another fantastic week last week, coming off some of their highs, but just firmly and just solidifying its level here well above 300. Really nice to see. You love to see it as a Google holder. So last week we had a trade of the week. If you tuned in, you saw it. If you're a Trading Zone subscriber, it was sent to you early in the morning last week. We sold. This was for a Black Friday, Cyber Monday trade. We sold the 105-100 put spread in December. We collected 150. This morning, I exited this position for 29 cents. So not a bad weekly return here. Of course, Walmart, fantastic week here. Bounced right new to all-time highs after Black Friday. Just absolutely crushing it, exactly as expected. This week, trading some volatility in NVDA. We're going to be looking at the money, which is at the 180. For NVIDIA. I'm expecting it to move away from this, and I want to own an upside call, but I want to kind of finance it, but just kind of capitalizing on my expectation that it's going to move. So I'm actually going to do this by selling a call butterfly, selling the 160, 180, 200 call butterfly, and then I'm going to add on to that 180, 200 call. So essentially selling 160, buying 3 180s, selling 200 calls. I'm going to collect money to do that. If it settles here, right here at 180, that'd be bad. That would turn into $20. But if we move above 200, fantastic. I can make $20 total on this trade. If you go below 160, again, that'll be just a small win on this trade. So that's where we're looking here. Definitely want it to go to the upside. Absolutely, obviously. Let's just take a real quick look again at NVIDIA here, where we've had some pain here. There's no question about it. We've had some pain. We're below this 200-day moving, this 50-day moving average here at 186. So, I'm looking for more downward movement or there. That's obviously what we're looking for over the next month. Just something just moving away from this 180 strike is where the trade wants to go. That's where I'm looking for some movement in NVIDIA, just getting away from where we are right now, using volatility to my advantage. So that is the trade of the day. Remember to hit me up in the comments. Feel free to leave a message. I love seeing those. It makes me feel real good. If you have any questions, feel free to shout me out. It is always fun to do these trades for you. I really get excited doing them. I really get excited doing the research on it. Hope you like it. I'll be here again next week, right here, 12 o'clock Eastern. You can have your lunch and check out what's going on the market and hear a trade at the end. I hope you enjoy it. I'm Joe Teague for Equity Armor Investments. Have a great week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.